Last night, while most people were counting down to midnight, I was watching a different kind of countdown. The kind that happens when a major institution realizes they might not survive to see the new year. At 9:30 p.m. Eastern on December 31st, the silver market didn't just decline. It was systematically taken apart, piece by piece, in what I believe was one of the most coordinated liquidation events I've seen in over a decade of analyzing this market. I'm a commodities analyst who's been stacking physical silver and trading metals for 12 years. I use this AI avatar for one reason: speed. I'm tired of waiting 12 hours for the financial media to report what I'm seeing happen in real time, and I'm tired of all these other AI channels pumping out recycled hype with no actual data behind it. Here's what happened. Silver closed last night at $71.39. That's a 5% drop in the final hours of trading. Meanwhile, the Federal Reserve injected $31 billion into the overnight repo market, the largest injection since the COVID crisis in March 2020. This morning, you're going to see headlines celebrating silver's incredible year. Up 150%, they'll say. Best performance in decades. And technically, they're right. But what they're not going to tell you is what happened in the last 60 minutes of 2025. They're not going to connect the dots between silver's rejection at $83 and that $31 billion emergency cash injection. They're not going to explain why the COMEX raised margin requirements to $25,000 per contract. And they're definitely not going to mention the rumors coming out of Asia that physical silver is trading at over $100 while the screen shows $71. The fireworks last night weren't just for the new year. For someone in the banking system, they were celebrating the fact that a $35 billion fire got put out just before the regulators came to inspect the building. Let me be clear about what I'm claiming here. The violent rejection of silver at $83 and the record repo injection are not separate events. They're two sides of the same coin. We are looking at what I believe is a massive institutional insolvency that was papered over in the final hours of the year. The street price of physical silver has completely decoupled from the Western screen price. The system is running on fumes, digitally manipulated to protect institutions that are drowning and losing positions. Here's what I'm going to show you. First, the exact mechanism they use to hide this crisis. It's called year-end window dressing, and once you understand it, you'll see it everywhere. Second, I'll run the actual math on that $31 billion injection and show you why the numbers are too precise to be coincidental. And third, I'll walk you through my personal plan for navigating the first week of trading in 2026. Let me show you what I was looking at on my terminal a few hours ago. Silver bid, 71.39, ask, 71.80, down 5.07%, in what should have been a sleepy final session. Gold, for comparison, was down just 0.5% at 43.16. Gold held steady while silver got hammered. But the critical detail is what happened before that close. Silver touched $83 earlier in the session. Look at that candle formation. In technical analysis, we call that a shooting star, a massive upper wick showing complete rejection of higher prices. That's not retail investors taking profits on their 10-ounce positions. That's institutional scale selling. Now here's where it gets interesting. The screen shows $71, but I've been hearing consistent reports from dealers that physical silver is trading at wildly different prices around the world. 130 in Tokyo, 106 in Kuwait. I can't confirm these numbers independently, but multiple sources are telling me the same story. If you can't actually purchase a physical bar of silver for $71, then is 71 really the price? Or is it just a number on a screen that's lost its connection to physical reality? Look at that chart one more time, that vertical drop at 9 p.m. That's not how profit-taking looks. Profit-taking is gradual, distributed over time. This was forced liquidation. Someone hit the panic button. Which raises the obvious question: why would anyone dump a winning position at the peak of its momentum, after a 150% run, at the exact moment it's breaking out to multi-decade highs? Because they didn't have a choice. And to understand why, you need to understand a mechanism that most people have never heard of. It's called year-end window dressing. Let me break this down simply because this is the key to everything. At the end of every fiscal year, banks have to report their balance sheets to regulators. They need to prove they have adequate capital reserves, that their leverage ratios are acceptable, that they're not taking excessive risks. The snapshot gets taken at midnight on December 31st. That number goes into official records. Now, if you're a bank and your books are a mess, if you have positions that look catastrophically bad on paper, you have two options. Option one, actually fix the problem, which is expensive and time-consuming. Option two, temporarily hide the problem just long enough to get through the inspection. Here's the analogy. You're 16 years old and your room is a disaster. There's junk everywhere, things you definitely shouldn't have, evidence of activities you're not supposed to be doing. Your parents text you. They're coming home in 10 minutes for a surprise inspection. What do? You don't actually clean the room. You don't have time. Instead, you grab everything, all the mess, all the contraband, and you throw it into your closet. You slam the door shut, you lock it. When your parents walk in, the room looks immaculate. They're impressed. Inspection passed. And tomorrow, after they leave for work, you open that closet door back up and deal with the mess. That's window dressing. And I believe the Fed's $31 billion repo injection was that closet. Here's the scenario I think played out. A major institution was heavily short silver. They probably built this position when silver was trading at $30 or $40, betting it would fall back down like it always does. Except this time it didn't fall. It ran to $83. That's not a small loss. At that price level, they were facing margin calls they couldn't meet. They were insolvent on that single trade. So what did they do? They liquidated. They sold aggressively into the market, creating massive downward pressure. That drove the price from 83 down to 71. That $12 drop reduced their mark-to-market losses just enough to make their balance sheet look acceptable for the midnight snapshot. But there's a problem. They still needed actual cash. They still needed liquidity to meet their immediate settlement obligations. That's where the Federal Reserve stepped in. $31 billion in overnight repo, the largest injection since COVID. That cash allowed them to meet their obligations, settle their trades, and present clean books to the regulators. The price drop wasn't the market reassessing silver's value. It was a regulatory maneuver. The price was pushed down to save a failing institution's balance sheet. And here's the thing about hiding your mess in a closet. Eventually, that door has to open again. Eventually, you have to deal with what's inside. And I think we're going to see that happen in the first week of January. Let me show you the math, because when you run the numbers, this stops looking like coincidence and starts looking like coordination. The Federal Reserve injected $31 billion on December 31st. They're calling it seasonal liquidity provision, standard year-end operations. Nothing unusual. But look at the historical data. The last time the Fed injected this much cash was March 2020, a global pandemic, a complete freeze of financial markets. Before that, September 2019, the repo crisis that appeared out of nowhere and disappeared just as quickly. These are not routine events. These are emergency responses to acute crises. If this is just seasonal window dressing, normal year-end activity, why is it the largest injection in 5 years? Why does it require the same level of intervention as a global pandemic? Now let me run a hypothetical scenario. Let's say a major bank was short 600 million ounces of silver at an average price of $30. Silver runs to $83. That's a $53 move against them. 600 million ounces times $53 equals $31.8 billion in losses. Add in margin requirements, forced liquidation costs, and settlement fees, and you're looking at approximately $35 billion needed to close out that position. The Fed injected $31 billion. The estimated loss is $35 billion. Those numbers are remarkably close. This isn't the Fed providing routine liquidity. This is the Fed covering someone's losing a bet because that someone is too systemically important to fail. Now compare this to what the mainstream narrative is telling you. They're saying silver dropped because traders took profits after a strong year. They're saying the Fed injection was planned, seasonal, routine. But if it was profit-taking, where's the gradual decline? Profit-taking happens over days or weeks as traders slowly exit positions. This was a vertical drop in a single hour. That's not profit-taking, that's liquidation. And if this was routine, why the margin hike? The comics raised margins to $25,000 per contract. That's a massive increase designed to force smaller players out of the market. You don't do that in a healthy market. You do that when you're worried about systemic risks and you need to reduce exposure fast. The math doesn't support the seasonal narrative. The numbers point to a localized failure in the metals market that required emergency intervention. Now let me address the counter-argument because I know what the skeptics are thinking. They're saying this: silver went up 150% this year. Of course, people are going to take profits at year end. The big traders want to lock in bonuses. The banks need liquidity to process those withdrawals. The Fed provided it. This is standard operating procedure. You're reading conspiracy into routine market mechanics. On the surface, that sounds completely reasonable. But let's examine it more closely. If this was just profit-taking, explain the margin hike. When markets are healthy and orderly, you don't need to raise margins to prohibitive levels. Margin increases are defensive moves. They're what regulators do when they're worried about cascading failures. They're designed to force out leveraged players who might not be able to meet their obligations. Profit-taking is gradual, it's orderly, it's distributed. This was a forced liquidation event with the volume and velocity of institutional panic. And let's address the idea that the Fed doesn't care about silver. You're right, the Fed doesn't care about silver as a commodity. But the Fed cares very much about the banks that are short silver. If a major bank fails because of a metals trade gone wrong, that's a contagion risk. That failure can cascade through the financial system. That's exactly the scenario the Fed was created to prevent. So let me summarize where we are. Silver hit $83. An institution likely went insolvent on their short position. The Fed provided $31 billion in emergency liquidity. The institution dumped their position, crushing the price to 71, just enough to make their year-end balance sheet look acceptable to regulators. The mess got shoved in the closet. The inspection was passed. But January 2nd, the door opens back up. What happens next? Here's what I'm expecting. The institutions are going to try to control the narrative. You'll see articles about silver's strong year and how the correction was healthy. They'll point to technical indicators and say the move was overextended. They'll normalize what happened. Meanwhile, the physical market is going to tell a different story. Those premiums in Asia aren't going away. If dealers are paying $100 for physical metal while the screen shows 71, that spread represents the real supply-demand dynamic. And I don't think we're going to see much mainstream coverage of that divergence because acknowledging it would expose the manipulation. I've built a simple dashboard of 3 indicators I'm watching this week. These will tell me whether the crisis is contained or still unfolding. First indicator, the $71 floor. If silver holds at or above 71 for the first 3 trading days of January, the squeeze is still active. It means the selling was temporary, just enough to pass the regulatory snapshot, and the underlying demand pressure is going to reassert itself. Second indicator, COMEX open interest. This is critical. If open interest collapses, it means the big shorts successfully close their positions using the Fed's emergency liquidity. The immediate crisis is over, at least on paper. But if open interest stays elevated, they're still trapped. The position is still there, just temporarily masked by Fed intervention. Third indicator, the repo facility. That $31 billion was provided December 31st. Watch what happens next week. If that number rolls off, if it decreases significantly, the emergency is over. The institution can stand on its own again. But if the Fed has to provide another 20 or 30 billion, if they have to keep rolling that facility forward, it means the problem isn't solved. The patient is still on life support. Look at the volume profile after that drop. The liquidity evaporated. That's not characteristic of a healthy market undergoing normal profit-taking. That is what happens when price is artificially suppressed and the market is waiting for permission to move again. So what am I personally doing while this plays out? I'm treating $71 as the line in the sand. Everything I do depends on how price behaves around that level. Here's my conditional framework. If 71 holds through the first week of January, I'm looking to add physical exposure. I'll interpret that $71 price as an involuntary gift from desperate institutions that needed to hit a regulatory target. If the physical market is actually trading at 100 to 130, and I can still acquire exposure at 71 on paper, that's a structural arbitrage I want to exploit. But if silver breaks down into the 65 to 68 range in the first few days of January, I'm pulling back entirely. A move that deep would signal that the selling wasn't just window dressing for year-end optics. It would mean the problem is bigger than one failed short, and the system is still unwinding positions. I don't want exposure during a systemic liquidation. And if we see another massive repo injection this week, 20 billion, 30 billion, anything in that range, I'm staying completely flat. That would confirm the closet door is jammed shut. The mess is still inside. The institution that needed the bailout is still insolvent, and the Fed is just buying time. When the financial plumbing is leaking billions of dollars per day, I don't want to be anywhere near it. I'm not trying to trade every tick. I'm not trying to catch short-term momentum. I'm watching the infrastructure. I'm watching the plumbing. And when I see $31 billion flowing through emergency channels, I pay attention to what that means about the system's stability. My core thesis is simple. The institutions can control paper prices. They've demonstrated that repeatedly. They can push numbers on a screen wherever they need them to be for regulatory purposes. But they cannot control the physical market. They cannot manufacture silver bars out of thin air. And as long as the physical market trades at a massive premium to paper, I know the paper price is artificial. The question is duration. How long can they maintain the illusion? And the answer depends entirely on whether they can stabilize whatever institution nearly collapsed last night. Let me wrap this up. The screen showed $71, but the system required $31 billion in emergency intervention. The books were balanced, the window was dressed, but the physical metal is still missing. The premiums in Asia are still real. The shortage is still real. They can manipulate paper prices. They've proven that over and over, but they cannot create physical supply. And eventually, physical reality overwhelms digital fiction. The new year has started, and the real battle for physical metal is just beginning. This isn't about whether silver goes up or down next week. This is about whether the Western paper markets can maintain control over price discovery, or whether the physical market is going to force a repricing. If you want context for how repo crises evolve, go back and watch my video on the September 2019 repo crisis. We've seen this pattern before. The mechanisms are the same. History doesn't repeat exactly, but the structure rhymes. I'll be monitoring those three indicators: the 71 floor, the open interest, and the repo facility. And I'll update you later this week, once we see how the system responds to the first real trading days of 2026. That's what I saw last night. That's what the data is showing me. And that's how I'm positioning around it. What you do with that information is your decision.